Now that we've talked about what happened, the reverse splits themselves, the next question is the one that really matters. What should investors be watching for after a reverse split cycle? Because the split isn't the event. It's the line in the sand. The first thing I'd pay attention to is what happens to the price after the reset. A reverse split gives a fund a fresh starting point, but it also removes the psychological flaw that existed before. If the price starts sliding again shortly after, that tells you the underlying pressure never went away. It means the market is still voting with its feet. The second thing to watch is the distribution itself, not just the size, but the behavior of it. If payouts remain extremely high while the share price continues to weaken, that's a sign the fund may be prioritizing yield optics over long-term stability. And on the flip side, if distributions start getting cut, delayed, or quietly adjusted, that's another signal. Neither outcome is inherently good or bad, but both are informative. Then there's net asset value. NAV doesn't lie, even when prices and yields try to distract us. After a reverse split, a healthy fund should at least stabilize. It doesn't need to skyrocket, but if NAV keeps grinding lower month after month, that's telling you the strategy is still bleeding under the surface. Another thing people don't talk about enough is volume and liquidity. Reverse splits reduce share count. Sometimes that leads to thinner trading, wider spreads, and more volatility on smaller moves. If volume dries up or price starts jumping erratically on low activity, that changes the risk profile whether people realize it or not. You also want to listen closely to how the issuer communicates after the split. Are they talking about adjustments to strategy? Risk management? Position sizing? Or are they mostly focused on marketing yield numbers again? Silence can be just as telling as overpromotion. And here's a big one that often gets overlooked: how the fund behaves during the next real market stress. Not a calm rally. Not a slow grind higher. I'm talking about sharp pullbacks, volatility spikes, macro shocks. That's when option-based income strategies show their true colors. If the fund struggles to hold NAV during turbulence, the odds of another split down the road quietly increase. Now zooming out a bit, this isn't just about one issuer or one product line. Reverse split cycles tend to show up late in broader market phases. They often coincide with tightening financial conditions, rising uncertainty, and the end of easy money assumptions. We're seeing more stress across credit markets, geopolitics, energy, supply chains, and even climate-related disruptions. All of that feeds back into volatility. And volatility cuts both ways. It can generate income, but it can also accelerate losses when things move too fast or too far. So what should investors really be asking themselves right now? Not, how high is the yield? But, how durable is the strategy? Not, how much did it pay last month? But, what does this look like across a full cycle? Reverse splits don't mean the story is over. Sometimes they mark a turning point. Sometimes they are just a pause before the next chapter. But either way, they force clarity. They remind us that income isn't free, that structure matters, and that in a world that's becoming more unstable by the year, resilience is worth more than optics. So that really brings me to the question I want to leave you with. As we look ahead to 2026, how should we actually be approaching high-yield ETFs? Is this a time to lean in early, or is there wisdom in waiting, letting the year find its footing, especially when the beginning of most years tends to be noisy, emotional, and uncertain? Because sometimes the biggest risk isn't missing out. It's stepping in too early, before the dust has settled and the real direction reveals its. That's exactly what I want to unpack in the next video, not just what to buy or avoid, but when patience becomes a strategy, and how to recognize the difference between opportunity and pressure. So take a moment to sit with that question. And if you value clarity over hype, and preparation over reaction, I invite you to join me in the next part of this conversation. Until then, stay grounded in what matters, move with intention, and remember, clarity before action, conviction before comfort. It's always better to be safe, not sorry.